Good morning friends and welcome back. This is the second video in the series of Let's Invest. I'm Tanuja Yadav, I welcome you back. Today I'm going to talk about the golden rules of investing. Now these are not something that you need to memorize just when I'm telling you, but this is something that you really need to live by. You have to remember them while you are investing. That is when you're doing your day-to-day activities of purchasing an asset. So they are really important. Let's go through them one by one. The first rule is that you have to work out your needs and objectives. And before you do that, the first question that you must ask yourself is, are you ready to invest? And to ask yourself that, there are three pointers which must be addressed. The first one is whether you have your debts under control. A person who is debt-ridden, a person who is pressurized with a lot of personal loans and a lot of car loans, lots of education loans, that person is not ready to make investments. I have known of people who borrow from the banks, who borrow from their friends, their relatives, just to invest in the markets, and they see their investments fail. So this is a big risk that they are taking. So please check your debt status before you think that you are ready to start investing. The second thing that you need to ask yourself is whether you have a contingency reserve in place. And what do I mean by contingency reserve? It really means that in case of an emergency, if you have a problem, you have sufficient amount of cash to help you live through your daily expenses. So most people believe that 3 months of living expenses are sufficient as a contingency reserve, but I am a little more conservative there, and I would say 6 months of the household expenses should be kept aside in your saving account. Do not use that money for aggressive investments. Keep them safe. Keep them in the savings account even if they don't give you a very good return. At that time, it is very important for you to maintain capital preservation for this reserve, for this emergency reserve that I'm talking about. The last question that you need to ask yourself is, do you have sufficient insurance protection? Do you have health insurance? Do you have household insurance? Do you have any other insurance which the lack of which can force you to dig into your investment corpus at a wrong time? So these three things handled, you would be ready to become an active investor. Now, once that is done, you also have to address what are going to be your goals for this investment. So for that, in the previous presentation, the previous video, I ended it with saying that you must have a plan in place. So that is what I need to remind you now, that it is one of the golden rules of investing that you need to pen down your goals. You need to pen down your objectives for each and every investment. Do you have an investment for a short-term period, that is 1 to 3 years? Is your investment there for medium term, say 3 to 7 years? Or are you investing for a long term, for retirement, post 7 years, 10 years, 15 years? So you have to segregate your investments, you have to segregate your goals, and you have to lay them down. I don't want to suggest here that you should burden yourself or get involved in a lot of paperwork. No, that is not what I'm suggesting. What I mean is that you have a clear-cut written down objective of why you want to invest, so that you can come back to it in case in future you forget what were your initial goals. You can modify them whenever you want, of course, but it is best to have them in written. The next golden rule of investing is to understand risk and return. Yes, the markets are very risky and they are very volatile. So you have to ask yourself a question that, are you willing to take this risk? What is your risk profile? So can we do away with the risk in the markets? Yes, of course we can. There are various ways. One very good way is diversification. As we had heard since the time we were children, don't put all your eggs in one basket. Again, that is what I want to tell you here. What happens if the basket slips out of your hands? Yes, so don't put all your savings in one investment. You should never do that. And you don't need to do that, because if the investment fails, you will be losing all your money. So you have to divide your investment into various asset classes. you have to put your savings in various pockets in different asset classes so that if one investment fails, the other investments are there strong to support you at the time of your need. The next important thing is that you should not be borrowing to invest. If you borrow from somebody and invest that money, it increases your risk manyfold. And why is that so? In case you have negative returns on your investment, it will add on to the interest that you have to pay on the borrowed money, and it will make your life really difficult. So please take out your savings and start investing them rather than borrowing and investing the borrowed funds. You should also be able to judge expected returns. Where there is return, there is risk as well. But there are times when you will hear certain borrowers tell you that they are going to give you a very high return on your investment. Say they will double your investment in 2 years. Do not get fooled by all these people. It does not happen like that. So if you know that the market is giving the average rate of return as 10%, 15%, if somebody is promising 100%, then that is definitely a red flag. That is something that you have to be wary about. Now this brings us to the next golden rule, which is you have to get to know the investment before you invest. Now, an investment has a lot of different parameters. You have to ask yourself, is capital preservation important to you? Do you want to make sure that the initial money, the principal amount that you invest, that should be safe? And in case something happens to that, then what? So this is the question that you need to ask yourself. The other thing that you have to consider before investing in any particular financial asset is, will that money be accessible to you? Now, generally, in our mindset, we know that if we buy a particular asset and if we need the money, we can always dispose of the asset and take the money. However, there are a lot of products in the market which have a lock-in period. The lock-in period could be 3 months, 6 months, it could also be in certain years. That means you will not be able to access your money for that period of time, for the lock-in period. In case you still want to take out your money, there will be penalties involved. There will be exit loads, which will further hamper your investment return. So this is something that you need to consider. You also have to keep in mind, what is your money being used for? So a lot of companies borrow money or raise capital for new projects, for capital improvements, for getting into some new technology. Now these are all good things because they will ensure that your capital will increase. It will ensure that you will have positive returns. However, there is also a possibility that somebody may just be borrowing money from you for running their operational expenses. Now that is bad. If you give somebody money, if you give a company money who is already tight on its cash, who is not able to generate enough cash from its operations, then it is highly unlikely that you will ever get to see your money back. So that is again something that you need to be careful about. The other thing that you have to think about is, what will be the tax implications on you? Now, the various investment products do have tax implications, and they do also have a negative impact on your returns. So if you get a 15% return and your tax bracket is around 35%, then your investment return just shrinks down to 10%. So is that what you want? Even if that is not what you want, you still have to be aware about it. You have to be aware about the tax implications. There are a lot of assets in the market which are beneficial from tax purposes. You get tax relief from them. But I do not anywhere want to suggest here that tax efficient vehicles are the best products to invest in. Yes, they are an option, but the most important thing is awareness. You have to be aware. So if you're being advised to invest in a product, you must find out what are the tax implications. Is it a tax exempt product? Is it a taxable product? When will the returns be taxed, etc., etc. Now after this, let's look at what is the next golden rule of investing. The next golden rule of investing is for you to monitor your investment. And when I say monitor, I really don't mean that every day you're opening your account, you're looking at all your shares and you're shares and debentures or your bonds, and you are getting worried about the market going up and down and you're panicking. No, that is not what I mean. What I mean is that monitor your investment at regular intervals. The regular interval could be a quarter, it could be 6 months, it could be a year, it could be when a particular event takes place, a particular economic event which could have an implication on your investments. So for example, when the government changes, then there are a lot of things that happen in the economy. The government may or may not favor certain industries. The government may encourage certain industries. The government may think about shutting down certain industries. So if looking at the current economic environment and the future economic environment, you may have to rebalance your portfolio. You may have to take out money from your portfolio, and you may have to invest in some other industry which may have better prospects in the future. So it is very important to regularly monitor your investments. Last but not the least is to avoid scams. In the financial market, there are a lot of fraudulent products. There are a lot of fraudulent people. There are people who want to take your money and run away with it and not give you anything in return. So you have heard about Ponzi schemes. You read about financial scams every next day in newspapers. Some are big, some are small. But what I don't want is, I don't want any of you to get involved in a scam. Again, one very important aspect to this is diversification. Now, we are all human. We can get carried away sometime. We can get influenced by friends, family, a financial advisor to invest in a fraudulent product. Even they may not be aware that it is a fraudulent product. It may appear to be really promising. But if you are well diversified, if only a small portion of your saving goes into that product, and if that turns out to be a scam, then again, your rest of the investments, the rest of your portfolio is there to support you. So be aware and remember these golden rules of investing. So that brings us to the end of this video. I really hope that you enjoyed it, and I will look forward to seeing you in video number 3. Keep learning and keep investing. Thank you very much.